Let's start with fixed income, because we saw a sell-off start in Japan overnight, and then we had the Treasury refunding, which showed obviously more sales of longer-term debt, among other things. And now we have a little bit of a sell-off and a 10-year above 3%. What do you make of all that?
We would say finally. It's where it probably should be. We had long anticipated that the Treasury refunding announcement was going to have to push yields a bit higher to attract investors to think about buying bonds. Additionally, part of the reason that we had a big rally in bonds earlier this year was risk sentiment for equities had gotten to very oversold levels as we were retesting the lows in April and then again close into May. So we had gotten some oversold readings, which to us meant that bonds were likely to sell off into it. So we think that bonds are starting to get back to something that is a little bit more reasonable for the environment that we're in.
So we know there were some block sales. So do we know if this 3% holds?
We would certainly think so. On our models, where we see the trajectory for U.S. economic growth, corporate profits, and the outlook for the continued tightening of interest rate policy, we would expect the 10-year Treasury to be able to hold above 3%.
And Barbara, are you looking for any sort of inversion? We know that the yield curve has been flattening. Of course, many have said with concern about whether this signals a recession or not. It looks as though the US growth story is still there to be held. Do you see an inversion in the yield curve further down the line?
This is a big topic of debate amongst many market participants as well as the Fed. The Fed issued a very interesting paper on the Treasury curve just a few weeks ago. There's talk about if it should be the 2-year, 10-year spread, should it be the 3-month, 6-quarter out spread. We think that the yield curve is an important indicator, but we know that it tends to coincide with recessions with very long and very volatile and very varied lags. So it's only one thing that we look at on a number of other issues that we think about for our recession. Our Voya probability of a recession model still says that there's a very low probability of recession over the course of the next 12 months in the U.S.
And certainly when you're looking at the growth status of jobs, ADP numbers coming out strong today, what do you think it signals for the likes of Friday?
Well, the job market has been very tight, and we're below the Fed's official target on the NAIRU level, which means that they're likely to continue to take up interest rates at a very gradual pace. What we're looking for in the FOMC statement today, of course, is really two things. We're looking for the "for now" language that Chairman Powell had talked about in his testimony to Congress to continue to probably stay in the statement. If it does not, and the Fed talks about a very rosy economic outlook, that may be interpreted as a bit more hawkish. So that's what we would be looking for today.